So gold has received a lot of attention lately. This is hardly surprising, as Ray Dalio, who manages around $140 billion, has been talking about investing into gold for some time. As Dalio manages the largest hedge fund in the United States, and I have to say is one of my investing idols, you might have noticed, if you want to protect or even grow your money, he is one of the smartest people on the planet that you and I should listen to. But what does this have to do with silver? Well, when gold begins to enter the conversation for investors, silver usually isn't too far behind. Silver has often been likened to gold, due to it having a similar role for investors and being far more affordable for the average person. However, there are a few things that I'm sure you don't know about silver, things that we'll uncover in this video. So, let's get straight into it. The first question is, why would you buy either gold or silver? They don't pay you a dividend like stocks, and you can't rent them out like a house. They are essentially just rocks that will sit there and do nothing. Well, as with every investment, it's because you think that the price will increase. Or, more accurately, because you think that the price of other investments, such as the stock market, will fall. Wait, what? This is interesting. When the stock market is doing well, the gold and silver prices will usually fall. When the stock market isn't doing well, gold and silver often excel. So in other words, they move in the opposite direction to the stock market. And that means that the reason you buy gold or silver is because you think the market will crash. Well, yes, but not exactly, because you don't have to think that the market will crash. Buying some gold or silver will protect you in case the market crashes. It's kind of like buying home insurance. You might not think the damage will come to your home, but you pay for it anyway to protect yourself just in case something does happen. So gold and silver are like insurance policies. If you invest 100% into them, that's obviously a big risk. But if you invest, say, 10 to 15% and the rest is in the stock market, well, you clearly think the stock market is going to increase. After all, you've invested the majority of your money into it. But you're reducing your potential loss just in case the market drops. You're diversifying yourself. But here's something you probably don't know. Gold and silver actually have very different uses. Here we can see the uses for gold in 2019. And only 327 tons were used for industrial purposes. So even though gold was highly purchased during 2019, we can see that the vast majority of this came from two purposes. Number one, jewelry, and number two, investment. In fact, the industrial uses of gold are only around 12%. Let's compare this with silver. For silver, 33% is used for jewelry, 11% is for investments, and a whopping 56% is used for industrial purposes, as silver is used in things like solar energy, phones, and computers. So what does this mean? Well, if gold and silver are used as market hedges, in other words, they tend to excel during the tough times, then isn't it a concern that we might start using less silver if the market drops? If the market does crash, it's likely that people will buy less phones and computers, they may invest less into solar energy, and that means less demand for silver. So, is silver actually a good insurance policy? Isn't it actually tied to the market? Well, let's now take a look by learning how the value of gold and silver act during these tough times. But quickly, I'd like to say this video took a while to research, so if you could take a moment to like it, I'd really appreciate it. So let's look at it. We know that gold does well in bad times, but what about silver? On the screen now, we can see a chart showing how gold and silver have reacted when the stock market has struggled. On the left are the dates of some of the stock market's worst times. The column next to it shows how much the American stock market dropped during these dates. The next column shows gold's price during these times. And finally, we have silver on the right. Looking at this, two things are clear. Number one, gold usually does very well in a stock market crash, with just a couple of exceptions. And number two, silver doesn't. In fact, silver increased on just 2 occasions and fell on the remaining 6. So there's your answer. Silver isn't a good insurance policy. Another short video. Thanks for tuning in. I'll see you again soon. Wait, no. that's not it, because this chart can actually be quite misleading. You see, when the market crashes, a couple of things usually happen. People immediately actually sell both gold and silver, as they want to hold some cash in fear of what is to come. And then sometime after this, gold begins rising. And then sometime after that, silver begins rising. And unfortunately, the chart you just saw cuts off some of silver's increases, which came after. So let's take a deeper look. On the left, you can see a chart showing how gold fell 29% in 2008. On the right, you can see another chart, this time showing how silver crashed 57%. Now on the left, you can see gold's price in the years after this crash. It increased 166%. On the right, you can also see silver's response gaining nearly 450%. Here's another example. Gold again is on the left and silver is on the right, both demonstrating massive losses. A 47% loss for gold and 43% for silver. Now here is the recovery. Gold has increased 440%, while silver has climbed a whopping 940. Even more interesting, let's look at the price of gold and silver over the past 50 years. Gold is shown by the blue line and silver by the orange. I know it's confusing, as gold itself is more orange and silver looks more like the blue line, but it is what it is. As we can see, the two don't always move in the same direction. And when the prices are moving, silver is often more extreme, both up and down. But considering this chart shows the entirety of the past 50 years, and it's difficult to pick out many times when both gold and silver are not moving in the same direction, it's pretty clear to me that both silver and gold are highly correlated and can both be considered as insurance policies in case of a crash. Now, I don't know about you, but the first thing that comes to mind for me is, well, if gold is a good insurance policy and silver is the same, why bother buying silver as well? Surely gold alone is enough. Well, the answer comes down to the famous gold to silver ratio. This is the price ratio between an ounce of gold and an ounce of silver. And let me tell you, it has fluctuated a lot. Here we can see a chart showing the ratio over the past 50 years. On the left, you can see a range of values from 20 to 110. This is basically how much more gold costs than silver. As we can see, as of today, gold is around 96 times more valuable than silver. Now, as an investor, the best strategy generally is to do the exact opposite of what most people do. If most people are buying a certain stock, for example, that's usually time to sell. If most people are selling a certain stock, it's often a good time to buy. Well, using this logic, we can see that investors are more bullish on gold than silver right now, as shown by the rising ratio, which is near all-time highs. So I can't help but wonder if the ratio will return to a lower level, where it has generally been throughout history. And if it drops, that means that investing into silver is the better investment out of the two. To add to this, Warren Buffett has previously described silver as gold on steroids, due to its much higher industrial usage than gold. So Warren Buffett is more of a fan of silver, but I don't want to mislead anyone. So it should be noted, this comment was made many years ago, and Buffett historically isn't a big fan of gold at all. But then again, with gold and silver being just rocks, they don't really change over time. So I'd say it's feasible. The Buffett's opinion on silver being gold on steroids hasn't changed either. Silver production is also dropping, with global mine production falling for the fourth consecutive year by 1.3%. As we know from supply and demand factors in economics, if the supply of something drops, then it's a positive factor for the price. Now obviously demand is a key factor too. You can't just look at the supply, but the production rate dropping is obviously bullish for the price of silver. But let's try to be neutral here and highlight a few negatives too. The first is that silver generally lags the price of gold. So if gold does do well, don't be surprised if there is another 6 months after where silver struggles. If you're a short-term investor and you're not thinking in timeframes of at least a few years, then silver isn't right for you. In fact, if you're only thinking short-term, maybe gold isn't right for you either. I would describe both as multiple year investments. Hence, it doesn't really matter what the price of gold or silver is today or tomorrow or what's happened over the past few months. It's the long-term price which counts. The next negative is that central banks simply don't view silver in the same way that they do gold, and therefore they tend to purchase gold in large quantities, but not so much silver. If some countries, for example, are concerned that the dollar may be inflated due to the ridiculous amount of money printing going on, then they may choose to hedge their bets by purchasing gold, but they probably won't buy silver. And let's not forget that central banks have a lot of money and they can print even more at will. So don't underestimate how much money they could use to purchase gold that won't be going towards silver. Also, silver is more volatile. In other words, it falls further in its worst times, but this does also mean that it increases more in its best times. If you think the prices of gold and silver are going to rise, silver could actually rise more. But being more volatile means it's also going to drop further if gold drops. So if you asked me, what would I say? Well, I'm not a financial advisor and I won't tell anyone what to do. These videos are simply me researching the market to get my own head around things, and then I share this with you. So I will say what I'm personally seeing. The data shows that the best way to protect your money is to invest into a diverse range of investments. So investing into at least some gold, not going all in on gold, but just some, clearly does make some sense. Investing into some silver also makes sense, especially when we consider the gold is particularly expensive versus silver at the moment. But silver is also more risky, so you could argue that it makes more sense to hold more gold than silver. Perhaps something like a 5-to-1 or 10-to-1 ratio. Either way, it's probably best for myself and for some people out there to use these investments as insurance, not to go all in. So I've recently put together a playlist breaking down how the world's best investors, people like Warren Buffett and Ray Dalio, are investing their money right now. If you'd like to learn from people much smarter than myself, click this link up here. Thank you for watching.